Welcome to your Q&A review for the WGU Cost and Managerial Accounting exam. We'll work through real exam-style questions, why each answer is right, why the others are wrong, and the theory behind it. Today we're covering Domain 1, Foundations of Cost and Managerial Accounting, including AIM, Financial versus Managerial Accounting, Price Takers and Price Makers, Product costs versus period costs, the three elements of product cost, prime cost, conversion cost, and inventory flow. And don't forget, our website offers free exam guides and practice questions to help you ace your D101 exam. Just grab the link in the description below and you'll have everything you need to study smarter, not harder, so you can walk in feeling fully prepared and confident. Alright, let's dive in. Question 1. A company's controller is preparing a forward-looking cost projection to help the plant manager decide how many units to schedule next quarter. The report follows no external rule book and will be used only inside the company. Which type of accounting does this best describe? Your options are A. Financial accounting because it reports the company's performance. B. Tax accounting because it projects a future obligation. C. Managerial accounting because it serves internal decision makers and is not bound by GAAP. D. Auditing because the controller is reviewing the numbers. Which one is it? Pause the video if you need more time. The correct answer is C. Managerial accounting because it serves internal decision makers and is not bound by GAAP. C is correct because managerial accounting serves internal users such as managers, is future-oriented, and follows no required external rules. A projection built to help a manager decide production volume is the textbook managerial use. A is wrong because financial accounting reports historical results to outsiders under GAAP. A forward-looking internal projection is the opposite of that on audience, timing, and rules. B is wrong because tax accounting follows tax law to compute amounts owed to the authorities. The scenario is an internal planning report, not a filing for the tax authority. D is wrong because auditing independently verifies financial statements to give outsiders assurance. Building a planning projection is not an audit of past results. Managerial accounting exists to serve the people running a company from the inside, handing managers the numbers they need to decide what happens next. 4 traits define it. It serves internal users, it looks toward the future, it follows no external rule book, and it supplies whatever level of detail a decision demands. Financial accounting faces outward and backward, giving investors a standardized, audited record of what already happened. Managerial accounting inverts that, facing inward and forward with flexible, decision-ready figures about what might happen. Picture a controller projecting next quarter's production cost at 3 output levels so a plant manager can pick a schedule. The page follows no prescribed template and rests on estimates because it exists only to sharpen a decision that hasn't been made yet. Words like internal, manager, forecast, projected, and estimate all point straight at managerial accounting. Whenever someone inside a company is planning for what hasn't happened yet. Question 2. An investor outside a company wants to decide whether to buy its stock, while the company's sales vice president wants a custom report showing which sales regions are profitable. Which statement correctly matches each user to the branch of accounting that primarily serves them? Your options are A. The outside investor is served by financial accounting. The internal sales vice president is served by managerial accounting. B. Both are served by financial accounting because both want profit information. C. The investor is served by managerial accounting. The sales vice president by financial accounting. D. Both are served by managerial accounting because both are making a decision. Take a second. Which answer would you pick? The correct answer is A. The outside investor is served by financial accounting. The internal sales vice president is served by managerial accounting. A is correct because financial accounting serves external users such as investors, while managerial accounting serves internal users such as the sales vice president. The match follows directly from who sits inside versus outside the company. B is wrong because financial accounting serves outsiders only. An internal manager wanting a custom regional report is the classic managerial accounting user, not a financial statement reader. C is wrong because this reverses the two roles. Investors are external and rely on financial accounting. The sales vice president is internal and relies on managerial accounting. D is wrong because managerial accounting serves only internal users. An outside investor cannot demand a custom internal report and instead relies on standardized financial statements. Every company keeps one set of records but reports from them in two directions. The first and sharpest fork in the road is audience. Financial accounting serves people outside the company, while managerial accounting serves people inside it. Outsiders like investors, banks, suppliers, and regulators are scattered and can't walk in and request a custom report. So they get standardized, comparable statements. Insiders sit in the opposite position. They can ask for exactly the report a decision requires, whenever it's needed. The same raw transaction can feed both a quarterly financial statement and an internal regional profit report, but the two outputs look nothing alike. Outsiders get summarized, audited, whole company figures, while insiders get detailed, unaudited, segment-level breakdowns made for immediate decisions. Both an investor and a sales director may care about profit, so the topic alone settles nothing. Position does. Words like investor, creditor, and regulator point outward to financial accounting, while manager, executive, and employee point inward to managerial accounting. Whether the reader sits inside or outside the firm decides the classification faster than any other clue. Ask who is meant to read the page, not what the page is about. Question 3. A newly promoted manager is surprised that the cost reports she receives internally do not follow gay pool and change format from month to month depending on the decision at hand. Which fact best explains why this practice is acceptable? Your options are: A. GAAP applies only to publicly traded companies and this company is privately held. B. The reports break the rules but are tolerated because they never leave the company. C. GAAP grants a first-year exception to any newly promoted manager. D. Managerial accounting follows no required external rulebook, so any format that helps the manager decide is acceptable. Before I reveal it, which one do you think is right? The correct answer is D. Managerial accounting follows no required external rulebook, so any format that helps the manager decide is acceptable. D is correct because managerial accounting is driven by usefulness rather than an external standard, so its format can change to fit each decision. No rule is broken because GAAP does not govern internal management reports. A is wrong because GAAP governs external financial reporting and is not waived simply because a firm is private. These internal reports skip GAAP because they are managerial, not because of ownership. B is wrong because internal management reports are entirely legitimate and are not regulated by GAAP at all. Nothing improper is happening. Managerial reporting simply has no mandated format. C is wrong because no such first-year exception exists. Internal reports are flexible because managerial accounting has no external rulebook in the first place. Managerial accounting has one of the most counterintuitive traits in all of accounting. It follows no required rulebook at all. Financial accounting must obey generally accepted accounting principles, but inside the company, the only standard a report must meet is whether it helps a manager decide well. The difference comes down to trust and verification. Outsiders can't see inside a company, so they need a shared rulebook and an audit to trust the numbers. But a manager down the hall doesn't need to prove anything to a co-worker, so binding that report to external standards would only add cost and rigidity. In practice, an internal report takes whatever shape the decision rewards, resting on estimates rather than audited figures, a break-even chart, a variance table, a make or buy comparison, and a special order analysis look nothing alike. And none resembles a formal income statement, because each is built backward from the decision it serves. The real contrast is between the mandatory world of financial reporting, answering to auditors and outside standards, and the discretionary world of managerial reporting, answering only to the manager who must decide. A report that changes shape every month isn't sloppy or improper. The standards were never meant to reach inside the company. Even a private company still owes proper statements when reporting outward. So it's the internal purpose of the report, not the company itself, that sets it free. Question 4. One report summarizes the whole company's results for the year that just ended. A second report breaks down next year's projected costs for a single product line in fine detail. Which report is the financial accounting output and on what basis? Your options are A. The product line projection, because it contains the most detail. B. The year-end summary, because financial accounting is historical and covers the whole company. C. Neither, because financial accounting never deals with costs. D. Both equally, because every accounting report looks backward. What's your answer? Commit to one before I continue. The correct answer is B. The year-end summary, because financial accounting is historical and covers the whole company. B is correct because financial accounting reports what already happened for the entire company at a summary level. A year-end whole company summary fits that description exactly. A is wrong because detailed, forward-looking, segment-level reporting is a managerial output. The depth of detail points toward managerial accounting, not financial accounting. C is wrong because financial accounting clearly reflects costs. For example, cost of goods sold on the income statement. The claim that it never touches costs is false. D is wrong because managerial reports are forward-looking rather than backward. A projection of next year's costs plans the future instead of reporting the past. Financial accounting reports a company's completed results to the outside world under a binding standard, always looking backward, and always summarizing the whole company rather than one piece of it. Capital flows toward businesses run by strangers, so investors, lenders, and regulators need a trustworthy account of how their money performed, verified under generally accepted accounting principles, so results compare cleanly across companies. The system is built for outsiders. Results come on a fixed schedule, quarterly and annually, cover the entire company at a summarized level, and get audited by an independent party so readers who can't verify anything themselves can still trust the numbers. Picture two reports on a controller's desk. One rolls the entire company's past year into a single statement for shareholders. The other forecasts next year's cost for one product line in fine detail for internal planning. The first is financial accounting, the second is managerial, no matter how detailed. Detail is a trap. A report crammed with numbers can still be managerial, while a thin summary can be financial. Ask only which way the report looks and how wide its lens is. Backward and whole company means financial accounting. Question 5. A controller observes that one set of the company's reports is audited and issued only on a quarterly and annual schedule, while a second set is produced on demand whenever a decision arises and is never audited. Which pairing is correct? Your options are A. The on-demand unaudited reports are financial accounting. The scheduled audited reports are managerial. B. Both sets are audited because every corporate report requires an external auditor. C. The scheduled audited reports are financial accounting. The on-demand unaudited reports are managerial. D. Audit status is unrelated to which branch a report belongs to. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. The scheduled audited reports are financial accounting. The on-demand unaudited reports are managerial. C is correct because financial statements are issued on a fixed schedule and audited, while managerial reports are produced as needed and are not audited. The pairing follows the standard frequency and audit distinction. A is wrong because this reverses the two. Scheduled audited output is financial accounting. On-demand unaudited output is managerial. B is wrong because only the external financial statements are audited. Internal managerial reports are not subject to an external audit. D is wrong because audit status is in fact one of the defining differences. Financial statements are audited and managerial reports are not, so the distinction matters here. Two practical clues let you classify almost any report instantly: how often it's produced and whether an outside auditor checks it. The pattern exists because outsiders and insiders make different demands. Investors and creditors want results at predictable intervals and need an independent audit since they can't check the numbers themselves. Managers just need a number when a decision arises and they trust the internal source without review. Picture a controller running two streams from the same office. One produces audited statements at fixed quarterly and annual dates for shareholders and lenders. The other produces unaudited costing and forecast packets whenever a manager asks. Watch for signal words: quarterly, annually, fixed schedule, and audited point to financial accounting, while on demand, as needed, and unaudited point to managerial accounting. The trap is assuming every corporate report must be audited. In truth, only external financial statements go through audit and internal reports stay unaudited by design. Question 6. A wheat farmer sells into a commodity market where many growers offer an identical product and the exchange quotes the going price. To earn a profit, which approach must the seller rely on? Your options are: A. Controlling and reducing its cost because the market sets the price and it cannot charge more. B. Adding a large markup to its cost because buyers will pay whatever it asks. C. Differentiating its grain with branding to justify a premium price. D. Setting price equal to cost plus a guaranteed margin. Which would you go with? Lock it in before the reveal. The correct answer is A. Controlling and reducing its cost because the market sets the price and it cannot charge more. A is correct because a price taker cannot influence the market price, so its only route to profit is keeping costs below that price through efficiency. Cost control is the defining focus of a price taker. B is wrong because buyers of a commodity will switch to another seller the moment one charges more. A price taker cannot tack on a markup because it does not set the price. C is wrong because meaningful differentiation is exactly what would turn a firm into a price maker. A grower of identical commodity wheat has nothing to command a premium with. D is wrong because cost plus pricing is the price maker's method. A price taker receives its price from the market rather than building it up from cost. Some companies don't set their own prices. The market sets the price for them. These firms are called price takers. And understanding what that means changes everything about how they compete. A price taker sells something so similar to what everyone else sells that charging more just sends buyers to the next supplier. A wheat grower, a crude oil producer, and a reseller of a standard item all face the same reality. The market hands them a price, and their only freedom is how they respond. Since raising the price isn't an option, the only path to profit runs through cost. Every dollar shaved off production falls straight to the bottom line, because the top line can't be moved, which is why commodity producers obsess over efficiency. Picture a family wheat farm selling into a grain exchange that quotes one price to every grower that morning. The farm can't post a higher price, since identical wheat sits available from 100 neighbors, so its profit depends entirely on trimming seed cost, fuel use, and yield per acre. The cleanest test is asking who controls the price. If the market controls it, the firm is a price taker fighting to get cost under a fixed ceiling. If the firm controls it, it's a price maker measuring cost precisely to build a price on top. Question 7. A pharmaceutical company holds a patent on a drug no competitor can copy, and it sets its selling price by starting from its cost and adding a markup. This firm is best described as your options are a price taker that must accept whatever the market offers. B. Price maker that needs an accurate cost figure to set a profitable price. C. Merchandiser that buys the drug finished and resells it. D. Service firm with no product cost to measure. Don't overthink it. Which one feels right? The correct answer is B. Price maker that needs an accurate cost figure to set a profitable price. B is correct because patent protection gives the firm power to set its own price, which makes it a price maker. Because it prices as cost plus markup, it must know its cost accurately or the markup is meaningless. A is wrong because a patent shields the firm from competitors dictating its price, the opposite of a price taker's position. It sets the price rather than accepting one. C is wrong because the company manufactures a patented drug rather than buying finished goods to resell. That makes it a manufacturer and a price maker, not a merchandiser. D is wrong because the firm produces a physical product with measurable manufacturing cost. It is not a service firm, and cost measurement is central to how it prices. A price maker is a company with enough differentiation, brand strength, patent protection, or market power to set its own price instead of accepting one from the market. This power comes from a moat rivals can't cross. A patent grants a legal monopoly. A strong brand earns loyalty that survives a higher price. And specialized capability lets a custom builder quote work no one else can perform. The mechanism is cost plus pricing. The firm measures its cost, adds a markup, and that sum becomes the price. So the entire structure depends on the accuracy of the cost figure at the base. For a price maker, cost comes first and price is built upward from it, so the task is measurement. For a price taker, price comes first and cost must be pushed down beneath it, so the task is suppression. Keep the arrow straight. A price maker starts with cost and builds the price on top, while a price taker starts with the market price and drives cost below it. Question 8. Two competitors make similar products. One knows its true cost to make each item and which customers are genuinely profitable. The other spreads overhead evenly and is unsure where it actually earns money. What advantage does the first company hold? Your options are A. It is legally permitted to charge higher prices than its rival. B. It pays lower income taxes because it tracks cost in more detail. C. It is exempt from GAAP because it uses managerial accounting. D. It can price to earn a profit and steer resources toward the work that actually earns the most. Got a guess? Lock it in. The correct answer is D. It can price to earn a profit and steer resources toward the work that actually earns the most. D is correct because knowing true cost lets a company price profitably and focus resources on genuinely profitable products and customers. The rival smearing overhead evenly may keep a cash drain in line without realizing it. A is wrong because cost knowledge grants no legal right to charge more. The advantage is sharper decisions, not pricing permission. B is wrong because detailed internal cost tracking does not by itself lower income taxes. The benefit is better pricing and resource choices, not a tax break. C is wrong because using managerial accounting does not exempt a firm from GAAP on its external reports. The two systems coexist. Cost insight is a decision advantage, not a reporting exemption. Understanding true cost isn't an accounting nicety. It's a genuine competitive edge. It separates firms that manage on data from firms that manage on hope, and it shows up directly in pricing, resource allocation, and which opportunities a firm accepts or declines. When cost is misunderstood, firms price below what a product needs and lose money, or price above market and lose the sale. Worse, resources pour into a line that only looks profitable because overhead was smeared evenly, while a genuinely strong line starves. The mechanism works through concrete channels. Knowing true unit cost sets a price that earns profit. Knowing real product and customer profitability focuses effort where returns are highest. Knowing how cost behaves with volume enables capacity planning. And knowing the cost of one more unit sharpens judgment on special orders. Picture two firms making similar products. One has traced its costs and knows the profit on every product and customer, so it prunes weak work and doubles down on strength. The other spreads overhead evenly and unknowingly keeps a money-losing line alive for years. Remember, knowing your cost doesn't grant a legal right to charge more, cut your taxes, or skip reporting standards. Its power is sharper decisions, pricing with intent, and steering resources toward real profit, again and again, until that edge compounds. Question 9. A custom manufacturer that quotes prices as cost plus markup consistently assigns far more overhead to each job than the job truly causes. According to the course materials, what is the most likely consequence? Your options are: A. Its products will be underpriced and it will lose money on every job. B. Its income statement will understate cost of goods sold. C. Its quoted prices will be too high, driving customers away. D. It will be forced to switch to becoming a price taker. Which one is it? Pause the video if you need more time. The correct answer is C. Its quoted prices will be too high, driving customers away. C is correct because overstating overhead inflates the computed cost, and a cost plus price built on an inflated cost comes out too high. The materials warn that over-applying overhead can drive customers away. A is wrong because overstating cost pushes the quoted price up, not down, so underpricing is the wrong direction. Underpricing would result from understating cost instead. B is wrong because over-applying overhead raises the cost assigned to jobs rather than understating cost of goods sold. The problem described is mispricing, not an understated expense. D is wrong because a firm does not automatically become a price taker because of a costing error. It remains a price maker that is simply pricing inaccurately. When a company prices jobs by adding a markup to cost, that cost figure has to be right, and overhead is the piece most likely to go wrong. Unlike direct materials and labor, overhead can't be traced cleanly to one job, so it must be applied using a rate. If that rate is built on faulty assumptions, it over-applies overhead, inflating the computed cost of every job before the markup even gets added. Picture a custom shop quoting machined parts as cost plus a markup. Its overhead rate has drifted too high, so every job costs out heavier than the work truly demands, and quotes climb above what the market will pay. The chain to remember is straightforward. More overhead applied leads to higher cost, which leads to a higher price, which drives customers to a rival with sound costing. It does not cause underpricing, and it does not understate cost of goods sold. Contrast this with the mirror image error. Under-applying overhead understates cost. So the firm prices too low and loses money on work it thought was profitable. Over application costs a firm at sales, under application costs at margin, and both trace back to the same root cause, inaccurate costing. Question 10. A manager says, given the price the market hands us, the only question that matters is whether we can get our costs below it. This statement reflects the central concern of which type of company? Your options are A, a price taker whose profit depends entirely on controlling cost. B, a price maker, which sets price as cost plus a markup. C, a merchandiser, which carries only one inventory account. D, a service firm, which has no direct labor. Take a second. Which answer would you pick? The correct answer is A, a price taker whose profit depends entirely on controlling cost. A is correct because beating a given market price through cost control is exactly the price taker's central question. Profit comes from driving cost below the price the market already set. B is wrong because a price maker sets its own price rather than receiving one, so its central question is what the product truly costs. The quote assumes the price is already fixed by the market. C is wrong because carrying one inventory account describes a merchandiser's bookkeeping, not the pricing concern in the quote. The statement is about cost versus market price, not inventory structure. D is wrong because whether a firm employs direct labor is unrelated to the quoted pricing concern. Service firms, in fact, often carry heavy direct labor in the form of billable time. Every price taker's strategy boils down to one question. Given the price the market has already set, can the company get its cost below that price, and by enough to earn a living? Having lost control of the top line, the price taker must find profit at the bottom. Unlike a differentiated seller who can command a premium, a commodity seller's product is interchangeable. So price is locked and cost becomes the only lever left to pull. A price taker studies cost the way a differentiated firm studies its brand. It constantly asks whether the market price even covers its cost, which methods produce the same output for less, and where the next efficiency gain will come from, since every reduction widens the profit gap beneath a fixed price. The key contrast graders test is direction. A price taker treats price as fixed and hunts for lower cost beneath it, while a price maker treats cost as the known input and builds a price on top of it. Whichever quantity is fixed versus free tells you which role you're looking at. Whenever a manager accepts the market's price and obsesses only over driving cost beneath it, that is the price taker's question in its purest form. Question 11. A manufacturer wants to know the total cost of running its painting department this year so it can judge that department's efficiency. In cost terminology, the painting department is serving as which of the following? Your options are A, direct cost because the department is easy to identify. B, a cost object because it is the thing for which a separate cost measurement is desired. C, a period cost because departments are administrative. D, an indirect cost because many products pass through it. Before I reveal it, which one do you think is right? The correct answer is B, a cost object, because it is the thing for which a separate cost measurement is desired. B is correct because a cost object is anything for which a separate measurement of cost is desired, and a department qualifies. The firm wants the painting department's cost, so the department is the cost object. A is wrong because a direct cost is a cost traced to an object, not the object itself. The department is the thing being costed, not a cost. C is wrong because product versus period describes how a cost is treated, not what a cost object is. The department is the target of measurement, not a classification of a cost. D is wrong because indirect describes a cost that cannot be traced to an object. The department here is the object itself. so the direct or indirect label does not apply to it. A cost object is anything for which a separate measurement of cost is desired. It can be a product, a job, a department, a customer, or a project. Whatever a company chooses to find the cost of becomes, by that choice, the cost object. Managers never ask about cost in the abstract. They ask about the cost of something specific in order to make a decision. Should this product line be kept? Is this customer worth the effort? What does the inspection activity really cost? Naming that target first is what brings discipline to everything that follows. Consider a furniture maker measuring how efficiently its painting department ran this year. The moment management decides to cost that department, it becomes the cost object. Paint traces to it directly, while a share of the plant manager's salary must be allocated, since that manager oversees several departments. The department itself is neither direct nor indirect, it is simply the thing being costed. A cost object answers the matter of what, while direct and indirect answer the matter of how those costs reach it. Watch for phrases like wants to know the cost of, or evaluate this department, this product, this customer. That name target is always the cost object. Keep the target and its costs distinct, and the whole costing problem falls into place. Question 12. A furniture maker chooses one wooden table as the cost object. The wood that physically goes into that specific table can be pointed to and tied directly to it. How is the cost of that wood classified relative to the table? Your options are A. An indirect cost because wood is also used in other products. B. A period cost because the materials were purchased before production began. C. A mixed cost because wood prices rise and fall. D. A direct cost because it can be easily and economically traced to the table. What's your answer? Commit to one before I continue. The correct answer is D. A direct cost because it can be easily and economically traced to the table. D is correct because A, direct cost, can be easily and economically traced to a chosen cost object. The wood in a specific table is traceable to that table, so it is a direct cost. A is wrong, because that other products also use wood does not stop the wood in this table from being traced to this table. Traceability to the chosen object is what decides it. B is wrong because materials that become part of the product are product costs, not period costs, and the purchase date does not change that. Direct materials attached to the unit. C is wrong because mix describes how a cost behaves as activity changes, not its traceability. The question is whether the wood can be traced to a table, which is a direct or indirect matter. A direct cost is one that can be easily and economically traced to a chosen cost object. The keywords are easily and economically. The link has to be clear and cheap to follow, not just theoretically possible. Tracing works through physical or documentary connection. The lumber cut for a specific table can be seen in that table, and a worker's hours appear on a time record tied to that exact job. No estimation, no spreading required. Picture a workshop that names one wooden table as its cost object. The boards that became that table can be pointed to and tied to it directly. And the fact that the same pile of lumber builds dozens of other tables changes nothing. Traceability to the chosen object is the only test. Signal language for direct costs includes traceable, easily traced, and identified with one specific object. Direct materials and direct labor are the classic examples. The concept to hold against it is the indirect cost, which is shared across many objects with no practical way to follow it to just one. Whether a cost is direct depends on the chosen object, not on whether the same resource also appears elsewhere. Follow the trail. If it's clean and affordable, the cost is direct. Question 13. A factory supervisor oversees the production of tables, chairs, and desks. The cost object is a single table. Because the supervisor's salary supports all of the furniture rather than one table, How is that salary treated relative to one table? Your options are an indirect cost that must be allocated because it cannot be traced to one table. B, a direct cost because the supervisor works in the factory. C, a period cost because supervision is an administrative activity. D, direct materials because the supervisor handles materials. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A, an indirect cost that must be allocated because it cannot be traced to one table. A is correct because the salary supports all the furniture at once and cannot be traced to a single table. So relative to one table, it is indirect and must be allocated. Indirect costs are spread across objects rather than traced. B is wrong because working in the factory does not make a cost traceable to one specific unit. The supervisor's effort is shared across all products, which makes it indirect to one table. C is wrong because the supervisor is factory labor, which is a product cost, not an administrative period cost. The point here is that it is indirect to one table, not that it is a period cost. D is wrong because direct materials are raw materials that become part of the product. A supervisor's salary is labor, and shared labor at that, not materials. Let's look closer at what makes a cost indirect and why factory presence alone doesn't decide the answer. An indirect cost is one that can't be easily traced to a single cost object because it's shared across many objects at once. Instead of tracing it, we allocate it, spreading it across everything it supports. The defining feature is shared benefit. One cost, several objects, no clean line to any single one. Picture a supervisor overseeing tables, chairs, and desks on the factory floor. Their salary supports all of it together, so it can't be traced to any one table. It must be allocated instead, using a sensible basis like labor hours or square footage. The key subtlety: working inside the factory doesn't make a cost traceable to one unit. The supervisor stands on the floor all day, yet their effort touches every piece of furniture, so it stays indirect to any single table. And the same cost can be indirect to one unit but perfectly direct to the larger object it belongs to. Remember, shared benefit, not physical presence, is what makes a cost indirect. Question 14. The same factory supervisor's salary is examined twice. Once with one table as the cost object, and once with the entire furniture factory as the cost object. What happens to its direct versus indirect classification? Your options are: A, it is indirect in both cases, because salaries are always indirect. B, it is direct in both cases, because the supervisor is a single person. C, it is indirect relative to one table, but direct relative to the whole factory. D, the classification cannot change once it has been set. Which would you go with? Lock it in before the reveal. The correct answer is C. It is indirect relative to one table, but direct relative to the whole factory. C is correct because relative to one table, the salary is shared and therefore indirect. But relative to the whole factory, it belongs entirely to that factory and is direct. The same dollar switches classification when the cost object changes. A is wrong because salaries are not always indirect. It depends on the chosen object. Relative to the whole factory, the supervisor's salary is direct. B is wrong because the salary is not direct to one table, because it is shared across all the furniture. Direct or indirect depends on the object, not on how many people are involved. D is wrong because classification absolutely can change when the cost object changes. That dependence on the chosen object is the entire point of the example. Whether a cost is direct or indirect is never a fixed property of the cost itself. It depends entirely on the chosen cost object, and the same dollar can flip categories when that object changes. The principle exists because tracing is only meaningful relative to something. Ask whether a cost is direct without naming the object, and there is nothing to answer. So classification always has to start with the object. Take a factory supervisor's salary examined two ways. Against one table, the salary supports all the furniture and can't be traced to that single table. So it's indirect. Against the entire furniture factory, that same salary belongs wholly to the factory, so it's direct. Watch for scenarios that examine the same cost against two objects, like one unit versus the whole factory, or that shifts the cost object partway through. These are deliberate signals that the question is testing whether your reasoning bends with the object. Direct and indirect are not permanent stamps, they're relationships anchored to a stated object. Every time, ask direct or indirect relative to what, because the label always follows the object. Question 15. An accountant explains that some costs are attached to a product by following a clear physical trail, while others are spread across products using a reasonable method because no clear trail exists. Which pair of terms matches this contrast? Your options are A. Variable costs are traced, fixed costs are allocated. B. Direct costs are traced, indirect costs are allocated. C. Product costs are traced, period costs are allocated. D. Prime costs are traced, conversion costs are allocated. Don't overthink it. Which one feels right? The correct answer is B. Direct costs are traced, indirect costs are allocated. B is correct because direct costs are traced to a cost object because a clear trail exists, while indirect costs are allocated because they are shared. Tracing versus allocating is exactly the direct versus indirect distinction. A is wrong because variable and fixed describe how a cost behaves with activity, not whether it is traced or allocated. A fixed cost can still be traced directly to an object. C is wrong because period costs are expensed immediately rather than allocated to product units. Tracing versus allocating describes direct versus indirect, not product versus period. D is wrong because prime and conversion are groupings of manufacturing cost elements, not a tracing versus allocating contrast. Each can contain both traceable and allocated pieces. Every cost reaches a cost object through one of two methods, and that choice is exactly what direct and indirect describe. Tracing follows a clear path from resource to object. Allocating spreads a shared cost across objects using a reasonable formula because no clear path exists. A direct cost is one that is traced, an indirect cost is one that is allocated. A traced cost is assigned with near certainty tied to the object by a record or physical fact. An allocated cost is assigned by estimate since a formula stands in for a missing trail. Picture steel that becomes a specific machine, followed straight to it through a materials record. A traced, direct cost. Now picture the factory's insurance, which protects the whole building, divided among all products by a formula, an allocated, indirect cost. Whether a cost is traced or allocated has nothing to do with whether it is variable or fixed, or product or period. Trace versus allocated concerns how a cost reaches an object. Variable versus fixed concerns how it behaves with volume. A single cost carries one label from each scheme at once, so keep the trace in matter separate. One method points straight to the object. The other apportions a shared cost by a base like labor hours or floor space. Remember, direct and indirect are just the labels those two assignment methods wear. Question 16. A manufacturer is sorting every cost it incurs into just two buckets so it can build its income statement correctly. Which split captures the fundamental dividing line taught for a manufacturer's costs? Your options are A. Direct cost versus indirect cost. B. Variable costs versus fixed costs. C. Controllable costs versus uncontrollable costs. D. Product costs versus period costs. Got a guess? Lock it in. The correct answer is D. Product costs versus period costs. D is correct because every cost a manufacturer incurs is either a product cost or a period cost, with no third category. That split decides whether a cost is inventoried or expensed immediately, which drives the income statement. A is wrong because direct versus indirect describes traceability to a cost object, not whether a cost is inventoried. It does not by itself decide income statement treatment. B is wrong because variable versus fixed describes behavior as activity changes. It is a separate scheme that does not determine whether a cost attaches to inventory. C is wrong because controllable versus uncontrollable concerns, which manager is responsible for a cost. It does not govern how a cost flows onto the income statement. Every manufacturing cost falls into exactly one of two camps, product cost or period cost, with no overlap and no third option. This single split decides how a cost lands on the financial statements, making it the most heavily tested classification in cost accounting. The dividing line exists to honor the matching principle. A cost tied to producing goods should be expensed only when those goods are sold. Product costs carry a future benefit, so they sit inside inventory, while selling and admin costs carry no such storable benefit and must be expensed right away. Picture a bicycle plant sorting its costs: aluminum, assembly wages, and factory overhead are product costs that ride inside inventory until a bike sells. Advertising, sales commissions, and headquarters salaries are period costs, expensed right away because they aren't part of making the product. The trap is reaching for a different scheme. Direct versus indirect concerns traceability, variable versus fixed concerns behavior with volume, and controllable versus uncontrollable concerns managerial responsibility. Only product versus period determines whether a cost is inventoried or expensed at once. When a question asks for the fundamental two-way split of a manufacturer's costs, remember, product costs are stored in inventory until the sale, and period costs are expensed the moment they occur. Question 17. A company finishes building a batch of products in March but does not sell them until May. What does the matching principle say about the manufacturing cost of those products as of March? Your options are: A. It stays on the balance sheet as inventory and asset until the units are sold. B. It is expensed in full in March when the units are completed. C. It is split evenly between March and May. D. It is never expensed because the units were made in-house. Which one is it? Pause the video if you need more time. The correct answer is A. It stays on the balance sheet as inventory and asset until the units are sold. A is correct because product costs are inventoriable, so they attach to the units as an asset and wait on the balance sheet until the sale. The cost becomes an expense only when the matching revenue is recognized in May. B is wrong because product cost is not expensed when units are completed. It is expensed when they are sold, which is the entire point of inventorable treatment. C is wrong because there is no even split across periods. The full product cost moves to expense at the moment of sale, not gradually over time. D is wrong because making goods in-house does not exempt their cost from ever being expensed. The cost becomes cost of goods sold when the units are sold. A product's cost isn't an expense the moment it's made. It becomes an expense only when it's sold, and understanding that gap is the key to this whole topic. Think of inventory as a holding tank. As goods are built, their materials, labor, and overhead pour in and accumulate as an asset. The cost just waits there, attached to the unit, until the sale finally drains the tank, and the cost becomes cost of goods sold. Picture the cost physically attached to the unit. While it sits unsold, it lives in inventory as an asset on the balance sheet. Only when the sale happens does that same cost move over to become cost of goods sold on the income statement. This all follows from the matching principle. Expense and revenue must land in the same period. Production alone creates no expense since it just moves cost from one asset account to another. Only the sale triggers the transfer, keeping product cost and asset right up until then. Contrast this with period cost, which never enter inventory and are expensed immediately, since they carry no future storable benefit. Whenever a scenario separates making from selling, that gap is where inventory quietly holds the cost until it's earned its match. Question 18. A company spends heavily on a national advertising campaign during a quarter in which it happens to sell nothing at all. How is the advertising cost treated in that quarter? Your options are: A. It is added to finished goods inventory until something sells. B. It is deferred until the first sale occurs. C. It is expensed in the quarter it is incurred because it is a period cost. D. It is treated as manufacturing overhead. Take a second. Which answer would you pick? The correct answer is C. It is expensed in the quarter it is incurred because it is a period cost. C is correct because advertising is a selling cost, which is a period cost, and period costs are expensed in the period incurred regardless of sales. No future inventory benefit can be attached to it. A is wrong because period costs never attach to inventory. Advertising cannot be parked in finished goods waiting for a sale. B is wrong because period costs are not deferred until a sale. They hit the income statement immediately, even in a quarter with no sales at all. D is wrong because manufacturing overhead is a factory cost that becomes part of product cost. Advertising happens outside the factory and is a period cost, not overhead. Let's dig into why period costs behave so differently from product costs, and why that distinction is such a favorite trap on exams. A period cost is any non-manufacturing cost tied to selling the product or running the company, like advertising, sales commissions, executive salaries, and the rent on non-factory buildings. These costs carry no benefit that can be stored in inventory, so they go straight to the income statement the moment they occur. Since there's no product sitting in a warehouse to attach the cost to, the matching principle has nothing to wait for. With no storable benefit, the only honest treatment is to recognize the expense right away in the period it happens. The mechanism is immediate expensing. A period cost never touches raw materials, work in process, or finished goods. It skips inventory entirely and lands on the income statement as selling and administrative expense, whether the company sold 1,000 units or none at all that period. That's the trap. A selling cost like advertising is expensed in full even in a quarter with zero sales, because its timing is tied to the calendar, not to revenue. Product costs are inventoried and wait. Period costs are expensed at once, no matter what. Question 19. A company pays 2 electricity bills. One powers the machines on the factory floor, and the other lights the corporate headquarters across town. How should each bill be classified? Your options are: A. Both are period costs because electricity is a utility. B. The factory electricity is manufacturing overhead and a product cost. The headquarters electricity is a period cost. C. Both are manufacturing overhead because both keep the company running. D. The factory electricity is direct materials. The headquarters electricity is overhead. Before I reveal it, which one do you think is right? The correct answer is B. The factory electricity is manufacturing overhead and a product cost. The headquarters electricity is a period cost. B is correct because electricity that runs factory production is a factory utility, which is manufacturing overhead and therefore a product cost. Electricity for the headquarters is a non-factory cost and is a period cost. Location decides the classification. A is wrong because being a utility does not make a cost a period cost. Factory electricity is manufacturing overhead, so the two bills land in different categories. C is wrong because headquarters electricity is incurred outside the factory, so it cannot be manufacturing overhead. Only the factory bill is overhead. D is wrong because electricity is never direct materials, because it does not physically become part of the product. The factory bill is overhead and the headquarters bill is a period cost. The same cost can be a product cost or a period cost, and the deciding factor isn't what the cost is called. It's where it happens. Electricity, depreciation, salaries, insurance, and property taxes can each land in either camp. What matters is not the label, but where and in service of what function the cost occurs. Picture a company paying 2 electricity bills. One powers machines on the factory floor, becoming manufacturing overhead and a product cost. The other lights headquarters across town, becoming a period cost, expensed immediately. The trap is classifying by the cost's name instead of its location. Factory electricity is overhead and a product cost. Office electricity is a period cost, even though the word electricity never changes. Whenever a cost's name alone seems ambiguous. Anchor on location, factory floor versus office, and the classification becomes clear every time. Question 20. A car sits fully built on a manufacturer's lot, having cost a known amount to produce. At what moment does that production cost finally become an expense on the income statement? Your options are A. When the car is sold, at which point its cost moves to cost of goods sold. B. When the car is completed and moved to the finished goods lot. C. When the raw materials for the car were first purchased. D. At the end of the fiscal year, whether or not it has sold. What's your answer? Commit to one before I continue. The correct answer is A. When the car is sold, at which point its cost moves to cost of goods sold. A is correct because a product cost becomes an expense only when the unit is sold, the moment it transfers from finished goods to cost of goods sold. Until that sale, the cost sits on the balance sheet as an asset. B is wrong because completion moves the cost from work in process to finished goods, but both are still assets. No expense is recognized at completion. C is wrong because purchasing raw materials only places their cost in raw materials, inventory, and asset. Nothing is expensed at the moment of purchase. D is wrong because the trigger for the expense is the sale, not the calendar. An unsold car's cost stays in inventory past year end. There is exactly one moment when a product's cost turns into an expense, and it is not what most people guess. Understanding this single trigger is the key to reading a manufacturer's financial statements correctly. Picture a finished car sitting on the lot. Its build cost rests quietly in finished goods inventory as an asset, earning no expense, even if it sits there past year end. Only when a buyer purchases it does that cost transfer to cost of goods sold, meeting the sale revenue in the very same period. This timing exists to serve the matching principle. A cost must be recognized as an expense in the same period as the revenue it helped generate. Since revenue only appears at the sale, the matching expense can only appear at the sale as well. Otherwise, you'd book an expense with no revenue to match it. Purchase, production, and completion all feel like plausible triggers, but they only shuffle costs between asset accounts, and the fiscal year end is just a date. None of these produces matching revenue, so none of them releases the expense. Only the sale does. The mechanism is simple. While a unit sits unsold, its cost lives in finished goods inventory, an asset. The instant it sells, that cost moves out of the balance sheet and into cost of goods sold, an expense. At the exact same moment revenue is recorded. Question 21. An instructor says every manufacturing cost falls into exactly one of 3 buckets that together make up product cost. Which 3 buckets are these? Your options are A. Selling, administrative, and financing costs. B. Fixed, variable, and mixed costs. C. Raw materials, work in process, and finished goods. D. Direct materials, direct labor, and manufacturing overhead. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Direct materials, direct labor, and manufacturing overhead. D is correct because the three elements of product cost are direct materials, direct labor, and manufacturing overhead. Every cost incurred to make the product is one of these three. A is wrong because selling, administrative, and financing costs are non-manufacturing period costs. They are not elements of product cost. B is wrong because fixed, variable, and mixed describe cost behavior, not the elements of product cost. A single product cost element can behave in any of those ways. C is wrong because raw materials, work in process, and finished goods are the three inventory accounts that hold cost as it flows, not the three elements that compose product cost. Every manufacturing dollar falls into exactly one of three buckets, and together they make up product cost. Direct materials are the raw inputs that become part of the product. Direct labor is the wages of the workers who physically build it. Manufacturing overhead is everything else the factory spends to make goods. And nothing falls outside these three. Picture an instructor sorting a factory's spending. The steel for the frame is direct materials. The welder's wages are direct labor, and the lubricant. Supervisor salary, rent, and machine depreciation all land under manufacturing overhead, since none of them is raw material or a builder's wage. Graders love decoy trios. The inventory accounts describe where cost sits as it flows. The behavior categories describe how cost reacts to volume and selling. Administrative and financing costs aren't product costs at all. Only materials, labor, and overhead name what product cost is made of. A single material dollar is direct materials by element, sits in work in process by location, and is variable by behavior, all at the same time. Question 22. At a commercial bakery, the flour that becomes part of every loaf can be traced directly to the bread produced. Into which element of product cost does the flour fall? Your options are A. Manufacturing overhead, because flour is a factory supply. B. Direct materials, because it physically becomes part of the product and is traceable to it. C. Direct labor, because workers handle the flour. D. A period cost, because food can spoil. Which would you go with? Lock it in before the reveal. The correct answer is B. Direct materials, because it physically becomes part of the product and is traceable to it. B is correct because direct materials are raw materials that physically become part of the finished product and can be traced to it. Flour becomes part of the bread and is traceable, so it is direct materials. A is wrong because manufacturing overhead holds indirect materials that are too small or shared to trace, such as cleaning supplies. Flour is a traceable main ingredient, not an indirect supply. C is wrong because direct labor is the wages of workers, not the materials they handle. The flour itself is a material, not labor. D is wrong because materials that become part of the product are product costs, not period costs. The risk of spoilage does not change the classification. Let's break down what actually makes a material direct. It comes down to a simple two-part test. First, the material has to physically end up inside the finished product. Second, the link between that material and a specific unit has to be clear and traceable, not estimated. Wood in a table or flour in bread both pass this test. Think of flour drawn for a day's bread. It's requisitioned, consumed in the loaves, and logged against that production run. When the bread is done, its cost is already traced inside the product. No allocation needed. Watch for the traps. Flour, yeast, and sugar become the bread and trace to it, so they're direct materials. But the baker's wage is labor, not material. And cleaning soap is consumed in the bakery, yet never becomes part of a loaf. So it's an indirect material inside overhead. If a cost fails traceability, it slides into overhead. If it's a wage rather than a substance, it's labor. Direct materials live in that narrow space where both conditions hold. Question 23. On an assembly line, workers are paid by the hour to bolt parts onto each unit as it passes, and their effort can be traced to the specific units they build. Which element of product cost are these wages? Your options are A. Manufacturing overhead, because all factory wages are overhead. B. A period cost, because wages are paid in cash each week. C. Direct labor, because the workers physically work on the product and their effort is traceable. D. Direct materials, because the workers add parts. Don't overthink it. Which one feels right? The correct answer is C. Direct labor, because the workers physically work on the product and the effort is traceable. C is correct because direct labor is the wages of factory workers whose effort can be traced to individual units of production. Line workers bolting parts onto specific units fit this definition exactly. A is wrong because not all factory wages are overhead. Only untraceable factory wages, such as the supervisors, are. Traceable line worker wages are direct labor. B is wrong because factory wages spent making the product are product costs, not period costs. How often the workers are paid does not change that. D is wrong because direct materials are the physical inputs, such as the parts themselves. The workers' wages are labor, even though the workers attach the parts. Direct labor is the wages of workers whose effort can be traced directly to the units they build. Think of the assembly line worker bolting parts, the baker shaping dough, or the machinist running a lathe on a specific job. This category exists because hands-on effort, like direct materials, can be tied to specific output with precision. A worker's hours get recorded against a job, turning labor into a traced cost rather than something spread across production. That keeps it distinct from supervisory and support labor that helps the factory run, but can't be pinned to one unit. The mechanism is time tied to output. A worker logs hours against a job, and those hours, valued at the wage rate, become the direct labor cost of that unit, attaching directly the same way traceable materials do. Not every factory wage is direct labor. The supervisor overseeing the floor, the custodian cleaning it, and the materials handler moving parts all earn factory wages. But none of their effort traces to a single unit. So all of it becomes indirect labor inside overhead. Whenever a scenario describes a worker's time tied directly to specific output, that's direct labor. But a factory wage supporting production in general, without tracing to a single unit, signals indirect labor instead. Question 24. A factory uses glue, nails, and machine lubricant in production, but these items are too small and too shared to trace to any single finished unit. How are these costs classified? Your options are A. Manufacturing overhead as indirect materials. B. Direct materials because they are consumed in production. C. A period cost because the amounts are minor. D. Direct labor because workers apply them. Got a guess? Lock it in. The correct answer is A. Manufacturing overhead as indirect materials. A is correct because materials used in production that cannot be traced to one unit are indirect materials, which fall into manufacturing overhead. Glue, nails, and lubricant are the standard examples. B is wrong because direct materials must be traceable to specific units. Items too small or shared to trace are indirect materials, not direct materials. C is wrong because these materials are consumed inside the factory, so they are product costs through overhead, not period cost. A small dollar amount does not make a cost a period cost. D is wrong because these are materials, not wages. Applying them does not turn the materials themselves into labor. Let's look at why some production materials never get traced to a single unit, and instead ride into product costs through overhead. Indirect materials are things like glue, nails, screws, lubricants, and cleaning supplies. They're genuinely consumed in making goods, but tracking the exact amount used per unit would cost more than the information is worth. The mechanism is pooling and allocation. Indirect materials join indirect labor and facility costs in one overhead pool, which is then spread across products using a base like labor hours or machine hours. The trap is the word materials, pulling students toward direct materials just because something is used in production. The real test is traceability. Direct materials trace cleanly to a unit, while indirect materials, though still product costs, reach the unit only through overhead allocation. Both are product costs, never period costs. The only question is whether the cost gets traced directly to a unit or allocated to it through the overhead pool. Question 25. A factory pays a production supervisor, a maintenance crew, and property taxes on the factory building. None of these can be traced to a single unit, yet all are costs of running the factory. How are they classified? Your options are A. Period costs, because none of them touches the product directly. B. Direct labor, because the people work in the factory. C. Direct materials, because the property came with the factory. D. Manufacturing overhead, because they are factory costs that are neither direct materials nor direct labor. Which one is it? Pause the video if you need more time. The correct answer is D. Manufacturing overhead, because they are factory costs that are neither direct materials nor direct labor. D is correct because manufacturing overhead is every factory cost that is not direct materials or direct labor, including indirect labor and factory facility costs. Supervision, maintenance, and factory property taxes all belong there. A is wrong because these are incurred inside the factory, so they are product costs through overhead, not period costs. Period costs are incurred outside the factory. B is wrong because direct labor must be traceable to individual units. A supervisor and maintenance crew support all units, so their wages are indirect labor, not direct labor. C is wrong because property taxes are a facility cost, not a raw material that becomes part of the product. They are overhead, not direct materials. Manufacturing overhead is the catch-all bucket for every factory cost that isn't direct materials or direct labor. It gathers two families of genuine production costs that simply can't be traced to a single unit. Indirect labor covers factory wages that support production but can't be traced to a unit, like supervisors, maintenance crews, materials handlers, and quality inspectors. Factory facility costs cover the building and equipment, utilities, rent, insurance, property taxes, and depreciation. The mechanism is simple. All these costs flow into one overhead pool, a predetermined rate, built on a base like machine hours, then spreads that pool across the units. So each finished good carries its allocated share of overhead alongside its traced materials and labor. The trap is confusing overhead with direct labor or period costs. Direct labor traces to units while overhead labor does not. Period costs happen outside the factory. Overhead happens inside it. So a factory custodian is overhead, while an office custodian is a period cost. The same job split by location. Ask two questions. Does the cost occur in the factory and can it be traced to one unit? If it's in the factory but can't be traced, it belongs in manufacturing overhead. Question 26. A cost accountant defines two combined measures. One adds the two directly traceable manufacturing inputs, and the other adds the costs required to convert raw materials into a finished product. Which pairing names them correctly? Your options are A. Prime cost is direct labor plus overhead. Conversion cost is direct materials plus direct labor. B. Prime cost is direct materials plus direct labor. Conversion cost is direct labor plus overhead. So prime cost is direct materials plus overhead. Conversion cost is direct labor plus overhead. D. Prime cost is direct materials plus direct labor. Conversion cost is direct materials plus overhead. Take a second. Which answer would you pick? The correct answer is B. Prime cost is direct materials plus direct labor. Conversion cost is direct labor plus overhead. B is correct because prime cost is direct materials plus direct labor, the primary traceable inputs. Conversion cost is direct labor plus manufacturing overhead, the cost to convert materials into a finished product. A is wrong because this swaps the two definitions. Prime is the traceable materials and labor, while conversion is labor plus overhead. C is wrong because prime cost does not include overhead, it is materials plus labor. Overhead belongs to conversion cost. D is wrong because conversion cost is direct labor plus overhead, not direct materials plus overhead. Direct materials sit inside prime cost. Manufacturing cost has 3 elements and 2 combined measures group them in useful ways. Prime cost and conversion cost each bundle 2 of the 3 elements, giving managers different lenses on the same underlying cost. Prime cost sums direct materials and direct labor, deliberately leaving out overhead. Conversion cost sums direct labor and manufacturing overhead, deliberately leaving out direct materials. Direct labor is the one element both measures share, since it's both a traceable input and part of the conversion efforts. Picture a plant. The steel and the welder's traceable wages go directly into the products, forming prime cost. The welder's wages and the factory overhead transform raw steel into a finished machine, forming conversion cost. The welder's wages appear in both totals, and that's intentional, not a mistake. The most common error is swapping components, sliding overhead into prime cost, or materials into conversion cost. The reliable anchor is meaning, not memorized names. Prime is the primary traceable inputs, and conversion is what turns materials into finished goods. Whenever these two are confused, ask what each one excludes. Prime cost leaves out overhead, conversion cost leaves out direct materials, and direct labor belongs to both. Question 27. A factory reports direct materials of $40,000, direct labor of $25,000, and manufacturing overhead of $30,000 for the month. What is its prime cost? Your options are A. $30,000, B. $55,000, C. $65,000, D. $95,000. Before I reveal it, which one do you think is right? The correct answer is C. $65,000. C is correct because prime cost is direct materials plus direct labor, which is $40,000 plus $20,000 or $65,000. Overhead is excluded from prime cost. A is wrong because the $30,000 figure is overhead alone, which is not part of prime cost. Prime cost combines materials and labor. B is wrong because the $55,000 figure is direct labor plus overhead, which is conversion cost, not prime cost. Prime uses materials and labor instead. D is wrong because the $95,000 figure is the total of all 3 elements, the total manufacturing cost. Prime cost leaves overhead out. Prime cost is the sum of direct materials and direct labor, the 2 directly traceable elements of product cost. It deliberately leaves manufacturing overhead out, measuring only the traceable core of what a product costs to make. This measure earns attention because materials and labor can be counted and timed against specific output, making the total unusually reliable. Isolating prime cost shows how much of a product's cost rests on solid, trace ground before allocated overhead enters the picture. The computation is direct. Find direct materials, find direct labor, and add the 2. A factory with $40,000 in materials and $25,000 in labor has a prime cost of $65,000, with overhead playing no part in the total. The most common trap is pulling overhead into the mix, which drifts toward total manufacturing cost or conversion cost instead. Conversion cost replaces materials with overhead, summing labor and overhead, while total manufacturing cost adds all three elements together. Checking which elements a total includes and confirming overhead is left out distinguishes prime cost from its neighbors with certainty. Question 28. Using the same figures, direct materials of $40,000, direct labor of $25,000, and manufacturing overhead of $30,000. What is the conversion cost? Your options are A. $55,000, B. $65,000, C. $70,000, D. $95,000. What's your answer? Commit to one before I continue. The correct answer is A. $55,000. A is correct because conversion cost is direct labor plus manufacturing overhead, which is $25,000 plus $30,000 or $55,000. These are the costs to convert raw materials into finished goods. B is wrong because the $65,000 figure is direct materials plus direct labor, which is prime cost, not conversion cost. Conversion replaces materials with overhead. C is wrong because the $70,000 figure matches no correct combination of these numbers. Conversion cost is specifically labor plus overhead. D is wrong because the $95,000 figure is the total of all three elements. Conversion cost excludes direct materials. Conversion cost is the sum of direct labor and manufacturing overhead, the costs required to convert raw materials into a finished product. It deliberately leaves direct materials out, isolating the transformation effort from the raw inputs themselves. This measure matters because for many products, the labor and factory support needed to transform materials matter as much as the materials themselves. A foundry or machine shop can spend more converting metal into parts than it spends on the metal, so managers isolate that transformation spending to study it on its own. The computation is straightforward. Find direct labor, find manufacturing overhead, and add them. A factory with direct labor of $25,000 and overhead of $30,000 has a conversion cost of $55,000, no matter how large the direct materials figure is. The neighbors most easily confused with conversion cost are prime cost and total manufacturing cost. Prime cost swaps overhead out and uses materials and labor instead, while total manufacturing cost adds all three elements together. Conversion cost alone pairs labor with overhead, so confirming materials are excluded keeps it cleanly apart from the others. The trap is adding direct materials, the very element conversion cost excludes. Keep it simple. Labor plus overhead is conversion cost, and materials belong to a different measure entirely. Question 29. A student notices that one of the three manufacturing cost elements is counted inside both prime cost and conversion cost. Which element is shared by the two measures? Your options are A. Direct materials, B. Manufacturing overhead, C. Indirect materials, D. Direct labor. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Direct labor. D is correct because direct labor appears in both prime cost and conversion cost, since prime is materials plus labor and conversion is labor plus overhead. It is the only element the two measures share. A is wrong because direct materials appear only in prime cost. Conversion cost does not include direct materials. B is wrong because manufacturing overhead appears only in conversion cost. Prime cost does not include overhead. C is wrong because indirect materials are part of manufacturing overhead, which sits only in conversion cost. They are not the shared element. Of the three elements of product cost, direct labor holds a special position It's the one element counted inside both prime cost and conversion cost. Prime cost is direct materials plus direct labor, and conversion cost is direct labor plus manufacturing overhead. Direct labor is the only element the two measures share, while materials belong to prime alone and overhead belongs to conversion alone. Picture the three elements in a row: materials on one end, overhead on the other, and labor in the middle. Prime cost brackets materials and labor, conversion cost brackets labor and overhead, so labor alone falls inside both brackets. Watch for signal phrases like shared by prime and conversion, or counted in both. Direct materials is a decoy pointing only to prime, and overhead is a decoy pointing only to conversion. Direct labor is the true shared element. Because direct labor genuinely belongs to both stories, adding prime cost and conversion cost together would count that labor twice, a point that sets up the next idea about total manufacturing cost. Question 30. A factory's prime cost is $65,000 and its conversion cost is $55,000. Yet, its total manufacturing cost is only $95,000 rather than the $120,000 those two figures add up to. What explains the $25,000 gap? Your options are: A. Some overhead was left out of the total manufacturing cost. B. The total manufacturing cost was understated by mistake. C. Direct labor of $25,000 is counted in both prime and conversion cost, so adding the two double counts it. D. Prime and conversion cost should never be added in the first place. Which would you go with? Lock it in before the reveal. The correct answer is C. Direct labor of $25,000 is counted in both prime and conversion cost, so adding the two double counts it. C is correct because direct labor sits in both prime and conversion cost, so summing the two counts direct labor twice. The $25,000 gap is exactly that double counted direct labor. A is wrong because no overhead is missing. Total manufacturing cost already includes all of the overhead. The gap comes from double counting labor, not from missing overhead. B is wrong because the total is correct at $95,000, the sum of the three distinct elements. It is the addition of prime and conversion that overstates, not the total that is understated. D is wrong because adding them is a fine check as long as the shared direct labor is subtracted once. The gap is fully explainable, not a sign the figures cannot be combined. Total manufacturing cost is simply direct materials, direct labor, and manufacturing overhead added once each. But if you instead add prime cost plus conversion cost, you get a bigger, wrong number, and the reason is surprisingly simple. Prime cost includes direct labor, and conversion cost also includes direct labor. So when you add prime cost plus conversion cost, materials and overhead each show up once, but direct labor sneaks in twice. Visually, direct labor sits inside both groupings at once. It belongs to prime cost and to conversion cost. So any sum of the two counts that same labor figure a second time. With prime cost at $65,000 and conversion cost at $55,000, their sum is $120,000. But the true total is only $95,000. That $25,000 gap is exactly the direct labor, not a missing cost. Just labor counted twice. Don't mistake the gap for an error or a dropped overhead figure. The true total counts every element once, so always build it directly from materials, labor, and overhead, and treat prime plus conversion only as a check after removing one copy of labor. Question 31. A new cost analyst is asked to list a manufacturer's inventory accounts in the order that cost flows through them, from purchase to sale. Which order is correct? Your options are: A. Finished goods, work in process, raw materials. B. Raw materials, work in process, finished goods. C. Work in process, raw materials, finished goods. D. Raw materials, finished goods, work in process. Don't overthink it. Which one feels right? The correct answer is B. Raw materials, work in process, finished goods. B is correct because cost enters as raw materials, moves into work in process during production, and lands in finished goods when complete. From there, it becomes cost of goods sold at the sale. A is wrong because this reverses the flow. Goods cannot be finished before the raw materials have been started into production. C is wrong because raw materials comes first before anything enters work in process. Production cannot begin until materials exist to start. D is wrong because work in process comes before finished goods, not after. Units must be in process before they can be finished. A manufacturer's product cost doesn't jump straight to expense. It flows through 3 inventory accounts in a fixed order, mirroring the physical journey of a product from storeroom to customer. Purchased materials land in raw materials inventory. Once production begins, that cost moves into work in process, where labor and overhead are added. When units are completed, the cost transfers into finished goods. At any moment, a company can see how much cost is parked at each stage: materials waiting in storage, partly built goods on the floor, and finished units waiting for buyers. This is exactly the visibility managerial accounting is built to provide. The order can never reverse, because a product cannot be finished before it's started or sold before it's finished. Contrast this with a merchandiser who buys goods already finished and needs only a single inventory account, since it skips production entirely. Raw materials, work in process, finished goods, in that order, every time, before finally becoming cost of goods sold at the sale. Question 32. As product cost moves through a manufacturer's 3 inventory accounts, all 3 balances sit on the balance sheet as assets. At which transition does the cost finally leave the balance sheet and become an expense? Your options are: A. When raw materials are moved into production. B. When work in process is completed into finished goods. C. When the materials are first purchased. D. When finished goods are sold and the cost moves to cost of goods sold. Got a guess? Lock it in. The correct answer is D. When finished goods are sold and the cost moves to cost of goods sold. D is correct because all 3 inventory accounts are assets, so cost stays on the balance sheet until the sale. Only when finished goods are sold does the cost become cost of goods sold, an expense. I is wrong because moving materials into production shifts costs from raw materials to work in process, both assets. No expense arises there. B is wrong because completion moves costs from work in process to finished goods, both still assets. The cost is not yet expensed. C is wrong because purchasing materials only loads raw materials inventory, an asset. Nothing is expensed at the moment of purchase. Cost travels through 3 inventory accounts before it ever touches the income statement. Let's trace exactly when it stops being an asset and becomes an expense. Raw materials, work in process, and finished goods are all assets. Moving cost between them just changes its form, not its status, so the balance sheet keeps holding it the whole time. Picture $1 of material cost moving through the plant, raw materials, to work in process, to finished goods, always an asset. Only when that finished unit is sold does the dollar cross into cost of goods sold, becoming an expense on the income statement. The first 2 transitions just rearrange the balance sheet because no revenue has appeared yet to match against. The matching principle waits for the sale and only then releases cost into expense. Buying, starting, and finishing all keep cost on the balance sheet. Selling alone turns it into an expense. Mistaking any earlier step for that moment crosses into the income statement too soon. Question 33. During production, a manufacturer adds the cost of materials drawn into the job, the wages of the workers building it, and a share of factory overhead. In which account do these three costs accumulate while the units are still being made? Your options are A. Work in process inventory, B. Finished goods inventory, C. Cost of goods sold, D. Raw materials inventory. Which one is it? Pause the video if you need more time. The correct answer is A. Work in process inventory. A is correct because work in process holds the direct materials, direct labor, and applied manufacturing overhead added as units are produced. It accumulates all three while the goods are still unfinished. B is wrong because finished goods holds the cost only after units are complete. Costs gather in work in process first, then transfer when finished. C is wrong because cost of goods sold receives cost only when units are sold. It is an expense account, not where in-process costs accumulate. D is wrong because raw materials holds only the cost of materials not yet placed into production. Once production starts, that cost moves to work in process. Let's look closer at work in process, the account where a product's cost comes together while it's still being built. Work in process holds three things at the same time: the direct materials drawn into production, the direct labor of the workers, and the manufacturing overhead applied as production proceeds. It's the only account where all three elements of product cost pile up together, because that's where the actual making happens. As materials are requisitioned, labor is logged, and overhead is applied. All three streams flow into work in process and pile up layer by layer. Once a unit is finished, its full accumulated cost moves out to finished goods, leaving unfinished units' costs behind. The trap is sending these costs to the wrong place. Raw materials holds only unused materials. Finished goods holds cost after completion, and cost of goods sold holds cost only after the sale. Work in process alone gathers materials, labor, and overhead during production itself. Whenever a scenario describes costs accumulating on units that are still being made, that's work in process, the home for cost that sits between raw storage and the finished warehouse. Question 34. At year end, a manufacturer has balances in raw materials, work in process, finished goods, and cost of goods sold. Which statement correctly places these on the financial statements? Your options are A. All four appear on the income statement as expenses. B. All four appear on the balance sheet as assets. C. The three inventory accounts are assets on the balance sheet, and cost of goods sold is an expense on the income statement. D. Only finished goods is an asset, and the rest are expenses. Take a second. Which answer would you pick? The correct answer is C. The three inventory accounts are assets on the balance sheet, and cost of goods sold is an expense on the income statement. C is correct because raw materials, work in process, and finished goods are assets reported on the balance sheet. Cost of goods sold is an expense reported on the income statement. A is wrong because the three inventory accounts are assets, not expenses, so they do not all sit on the income statement. Only cost of goods sold is an expense. B is wrong because cost of goods sold is an expense on the income statement, not an asset. The three inventories are the assets. D is wrong because all three inventory accounts are assets, not just finished goods. Raw materials and work in process are assets on the balance sheet as well. A manufacturer's product costs split cleanly across two financial statements, and knowing which account belongs where reveals whether that cost is still an asset or has already become an expense. Raw materials, work in process, and finished goods are assets on the balance sheet, since those goods can still be sold. Cost of goods sold is different. It's an expense on the income statement representing units already sold. Cost rides the balance sheet as an asset through the 3 inventory accounts, then crosses to the income statement only when a sale happens, becoming cost of goods sold, which is subtracted from sales to reach gross profit. Don't sweep all 4 accounts onto one statement or call inventory an expense. The 3 inventories are assets. Cost of goods sold is an expense, and treating only finished goods as an asset ignores that raw materials and work in process are assets too. Keep the pairing straight. Inventory is the asset that stores cost until sale, while cost of goods sold and period costs are the expenses that hit income. That distinction is exactly what the 2 statements exist to preserve. Question 35. A retailer that buys finished goods and resells them is compared with a manufacturer that makes its own goods. How do their inventory accounts differ? Your options are: A. The retailer carries 3 inventory accounts and the manufacturer carries 1. B. The retailer carries 1 inventory account while the manufacturer carries 3. C. Both carry exactly 3 inventory accounts. D. Neither carries any inventory account. Before I reveal it, which one do you think is right? The correct answer is B. The retailer carries 1 inventory account while the manufacturer carries 3. B is correct because a merchandiser buys goods already finished, so it needs only 1 merchandise inventory account. A manufacturer makes its goods and carries raw materials, work in process, and finished goods. A is wrong because this reverses the 2. The manufacturer carries 3 accounts and the retailer carries 1. C is wrong because a retailer does not produce goods, so it has no raw materials or work in process. It carries a single merchandise inventory account. D is wrong because both hold inventory of some kind. A retailer holds merchandise and a manufacturer holds 3 classes of inventory. How many inventory accounts a company carries depends entirely on whether it makes its goods or simply resells them. A merchandiser buys finished goods and resells them as is, so it carries a single merchandise inventory account. A manufacturer builds goods from raw inputs, so it carries 3: raw material, work in process, and finished goods. A service firm produces no physical inventory at all. The reason is simple. Production creates stages, and each stage needs its own account to hold cost. Materials come in, work in process holds goods during building, and finished goods waits until sale. 3 distinct states demanding 3 accounts. A retailer skips all of this since its goods arrive already complete. A common trap is assuming a large retailer needs many accounts and a small factory needs few. But the logic runs the other way. The manufacturer's production stages demand 3 accounts, while the merchandiser's single ready-to-sell state needs only 1. Watch for the phrase buys goods already finished as your cue for a single merchandise account. Sort any company by how much it transforms. A service firm holds 0 inventory, a merchandiser holds 1, and a manufacturer holds 3, and you'll always predict the right count. Question 36. A plant manager observes that one cost rises and falls in total as production volume changes, while another stays the same in total no matter how many units are made, at least within normal operating volumes. How are these 2 costs classified by behavior? Your options are: A. Both are variable cost. B. Both are fixed cost. C. The first is fixed and the second is variable. D. The first is a variable cost and the second is a fixed cost. What's your answer? Commit to one before I continue. The correct answer is D. The first is a variable cost and the second is a fixed cost. D is correct because a variable cost changes in total in proportion to activity, while a fixed cost stays constant in total within the relevant range. The cost that moves with volume is variable, and the one that holds steady is fixed. Is wrong because only one of the 2 changes with volume. The cost that stays constant in total is fixed, not variable. B is wrong because only one of the two is constant in total. The cost that rises and falls with volume is variable, not fixed. C is wrong because this reverses the two. The cost that changes with volume is variable and the constant one is fixed. Cost behavior describes how a cost changes or doesn't change as activity levels shift. The two foundational patterns every manager must recognize are variable costs and fixed costs. Planning requires predicting how costs move as volume shifts. A manager deciding how much to produce, what to charge, or whether to accept an order needs to know which costs will rise with extra activity and which will hold steady, or every projection is just a guess. The mechanism is the relationship between total cost and activity. A variable cost total rises along a straight line through the origin, like direct materials or sales commissions. A fixed costs total is a flat line, like factory rent or the plant supervisor's salary. The trap is judging behavior by the wrong measure. Behavior means total behavior with volume. A variable costs total moves with activity. A fixed costs total does not, and fixed costs only hold within the relevant range. The symmetry to remember: a variable cost per unit amount stays constant, while a fixed cost total stays constant. Anchoring on total behavior first keeps variable and fixed correctly assigned. Question 37. Each unit a company makes requires $3 of direct materials, and the company is deciding between producing 1,000 units and 2,000 units. What happens to the materials cost per unit as volume rises? Your options are: A. It stays constant at 3 per unit even though total materials cost doubles. B. It falls because the materials are spread over more units. C. It rises because more materials are needed. D. It drops to 0 once volume is high enough. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. It stays constant at $3 per unit even though total materials cost doubles. A is correct because a variable cost is constant per unit and only its total changes with volume. At $3 per unit, total materials rise from $3,000 to $6,000, but the per unit figure stays $3. B is wrong because spreading a fixed pool over more units is fixed cost behavior. Variable materials do not get cheaper per unit as volume rises. C is wrong because the per unit materials cost does not climb with volume, it holds steady. Only the total rises as more units are made. D is wrong because a variable cost per unit never falls to 0. Each additional unit still consumes 3Ds of materials. Variable costs have a surprising signature. The total rises and falls with volume, but the cost per unit never changes. Every unit consumes the same slice of resource, no matter how many units are made. This pattern follows directly from what variable means: a cost incurred per unit of activity. So by construction, every unit carries the same slice. The total grows only because there are more units, while the per unit rate is locked in. Picture a product needing $3 of materials per unit. At 1,000 units, the total is $3,000. At 2,000 units, it's $6,000. The total doubled, but the per unit cost stayed exactly $3 both times. The classic trap is expecting variable cost per unit to fall as volume rises, borrowing behavior that actually belongs to fixed costs, which spread a constant total over more units. Variable costs have nothing to spread. They're incurred fresh for each unit, so the per unit figure holds flat, while fixed cost per unit is the true mirror image that falls. Watch for phrases like per unit stays the same, or total changes while per unit holds. Pasti, san, z. That's your cue. It's a variable cost question, not a fixed one. Question 38. A factory's rent is $12,000 per month and does not change with output. As monthly production rises from 1,000 units to 4,000 units, what happens to the rent cost per unit? Your options are: A. It stays at $12 per unit at every volume. B. It rises as more units share the building. C. It falls from $12 per unit toward $3 per unit as the fixed rent is spread over more units. D. It disappears because rent is not a product cost. Which would you go with? Lock it in before the reveal. The correct answer is C. It falls from $12 per unit toward $3 per unit as the fixed rent is spread over more units. C is correct because total fixed rent stays at $12,000, but spreading it over more units lowers the per unit amount. At 1,000 units it is $12 each, and at 4,000 units it is $3 each. Is wrong because fixed cost per unit does not stay constant. That pattern describes variable cost per unit. Fixed cost per unit falls as volume rises. B is wrong because fixed cost per unit falls rather than rises as output grows. Spreading the same rent over more units lowers each unit's share. D is wrong because factory rent is manufacturing overhead, a product cost, and it does not vanish. Its per unit amount simply shrinks as volume rises. A fixed cost stays constant in total, but its per unit cost behaves in the opposite way, falling as volume rises and climbing as volume drops. This inverse pattern is the source of many exam traps and the engine behind economies of scale. The pattern follows from spreading. A fixed total is committed for the period no matter how many units are made. So when that constant total is divided across more units, each unit slice gets smaller. Consider factory rent of $12,000 a month unchanged by output. At 1,000 units, that's $12 per unit. At 2,000 units, $6 per unit. At 4,000 units, just $3 per unit. The total never moves, only the per unit share falls. The common trap is assuming per unit fixed cost stays flat or rises with volume. Neither is correct. Fixed and variable costs are mirror images. The fixed total stays constant while its per unit figure falls, and the variable per unit figure stays constant while its total changes. When output grows, the fixed cost per unit falls while the total holds steady. Keep that pairing straight and you'll never fall for the trap. Question 39. As a company increases production, its total cost per unit falls, largely because the same total fixed cost is divided among more units. What concept does this falling per unit total cost illustrate? Your options are: A. The relevant range. B. Economies of scale. C. A stepped cost. D. A mixed cost. Don't overthink it. Which one feels right? The correct answer is B. Economies of scale. B is correct because economies of scale are the per unit savings a company gains as volume rises, driven mainly by spreading fixed cost over more units. The falling per unit total cost is that idea in numbers. A is wrong because the relevant range is the activity band where cost behavior assumptions hold, not the savings from higher volume. It sets boundaries rather than describing the falling per unit cost. C is wrong because A stepped cost jumps in chunks at thresholds and does not describe a smoothly falling per unit cost. The scenario shows spreading, not stepping. D is wrong because A mixed cost has both a fixed and a variable part. That structure is not what the falling per unit total cost illustrates here. Economies of scale describe the proportionate cost savings a company gains as it produces more. The visible sign is simple. Per unit total cost falls as output rises. Fixed costs like rent, salaries, and depreciation stay the same no matter how much is produced. So spreading them over more units shrinks each unit's share. On top of that, buying in bulk earns discounts, and specialized workers waste less, layering real efficiencies onto the fixed cost effect. Picture a manufacturer raising output across a season. The fixed costs never grow, so each new unit carries a smaller slice of that same burden, and total cost per unit slides steadily downward. Watch for the trap. The relevant range just sets the band where cost behavior holds. A stepped cost jumps in chunks at thresholds, and a mixed cost blends fixed and variable parts. Economies of scale is none of these. It's specifically the falling per unit total cost as fixed cost, spreads thinner over rising volume. Whenever a scenario shows per unit cost declining because fixed costs are spread across more units, that's your reliable thread back to economies of scale. Question 40. A budgeting problem states that all of its cost behavior assumptions hold only within the relevant range. What does that phrase tell the analyst to assume about fixed and variable costs? Your options are: A. Fixed costs vary in total and variable costs are constant in total. B. All costs behave as mixed cost. C. Fixed and variable costs both fall to zero. D. Total fixed cost stays constant and variable cost per unit stays constant. Got a guess? Lock it in a... The correct answer is D. Total fixed cost stays constant and variable cost per unit stays constant. D is correct because within the relevant range, the standard behaviors hold. Total fixed cost stays constant and variable cost per unit stays constant. That is exactly what the phrase signals the analyst to assume. A is wrong because this inverts the behaviors. Fixed cost is constant in total, and variable cost is constant per unit, not the other way around. B is wrong because the relevant range does not turn every cost into a mixed cost. It simply means the usual fixed and variable behaviors apply. C is wrong because costs do not vanish within the relevant range. They follow their normal fixed and variable patterns. Every cost formula comes with fine print. It only holds within a certain band of activity called the relevant range. Inside this band, variable cost per unit stays constant. Total fixed costs stay constant, and the relationship between cost and volume stays a straight line. Think of the relevant range as a warranty. Your simple cost model is guaranteed to work only within its boundaries. Push volume too low, and a company might idle equipment or cut staff. Push it too high, and it may need a second shift or new machine, stepping fixed costs upward and disturbing the variable rate. So whenever a problem says within the relevant range, it's giving you permission to trust the standard fixed and variable pattern, nothing more exotic. Question 41. A salesperson is paid a guaranteed base salary every month plus a commission equal to a percentage of whatever they sell. What type of cost behavior does this pay arrangement display? Your options are: A mixed cost because it has a fixed base plus a variable component that grows with activity. B, a purely variable cost because a commission is involved. C, a purely fixed cost because there is a base salary. D, a stepped cost because pay jumps at thresholds. Which one is it? Pause the video if you need more time. The correct answer is A, a mixed cost, because it has a fixed base plus a variable component that grows with activity. A is correct because a mixed cost combines a fixed component with a variable component. The guaranteed base is the fixed part, and the commission that grows with sales is the variable part. B is wrong because a purely variable cost would have no guaranteed base. The fixed salary means part of this cost does not move with sales. C is wrong because a purely fixed cost would not change with sales at all. The commission portion clearly rises with sales, so it is not purely fixed. D is wrong because a stepped cost stays flat and then jumps in chunks at thresholds. This pay rises smoothly with each dollar of sales rather than in large steps. A mixed cost, also called a semi-variable cost, blends two behaviors at once. A fixed base you owe no matter what, plus a variable amount that grows with activity. Many everyday costs carry both a committed floor and a usage-driven climb. Think of a phone plan with a flat fee plus usage, a salesperson earning salary plus commission, or a delivery deal combining a fixed lease with a per-mile charge. The formula is simple. Total mixed cost equals the fixed component plus the variable rate times activity level. On a graph, it starts above the origin at the fixed base, then rises in a straight line whose slope is set by the variable rate. The trap is picking just one label. Noticing only the commission makes it look purely variable, while noticing only the salary makes it look purely fixed. But a mixed cost has both a committed floor and a sales-driven climb at once. Whenever a scenario describes a guaranteed minimum paired with an amount that grows continuously with activity, that's your signal for a mixed cost, distinct from pure fixed, pure variable, and the chunky jumps of a stepped cost. Question 42. A salesperson earns a base of $2,000 per month plus 5% of sales. In a month with $40,000 of sales, what is the total cost of the salesperson's pay? Your options are A. $2,000, B. $3,000, C. $4,000, D. $6,000. Take a second. Which answer would you pick? The correct answer is C. $4,000. C is correct because total mixed cost is the fixed base plus the variable rate times activity, which is $2,000 plus 5% of $40,000. That is $2,000 plus $2,000 or $4,000 down. A is wrong because the $2,000 figure is only the fixed base and ignores the commission earned on sales. The commission must be added in. B is wrong because the $3,000 figure would require a commission of only $1,000, which understates 5% of $40,000. The correct commission is $2,000. D is wrong because the $6,000 figure overstates the commission. 5% of $40,000 is $2,000, not $4,000. So the total is $4,000. Computing a mixed cost means applying its structure. Total cost equals the fixed base plus the variable rate times activity. The trick is keeping the committed base and the usage-driven amount separate until the very end, when you sum them. Why does this matter? A manager can't project a mixed cost without splitting it first. Budgeting requires knowing how much stays steady and how much scales with activity. So blurring the two pieces sends any new projection wrong. Take a salesperson earning a $2,000 base plus 5% commission in a month with $40,000 of sales. The variable piece is 5% of $40,000 or $2,000 added to the $2,000 base for a total of $4,000. The trap is grabbing only one component. A student who reports just the base ignores the commission, and a student who computes only the commission drops the guaranteed salary. A pure fixed cost is base alone. A pure variable cost is rate times activity alone, but a mixed cost demands both, never substituting one piece for the whole. Whenever a problem hands you a fixed base, a variable rate, and an activity level, multiply the rate by the activity and add the base. Drop either piece and you've lost half the mixed cost. Question 43. A cost stays flat over a range of activity, then jumps by a large chunk when activity crosses a threshold, then stays flat again until the next threshold. Which cost behavior does this describe? Your options are A. A mixed cost, B. A stepped cost, C. A purely variable cost, D. A purely fixed cost. Before I reveal it, which one do you think is right? The correct answer is B. A stepped cost. B is correct because a stepped cost is constant over a range, then jumps in a chunk at a threshold, then holds flat again. That staircase pattern is exactly what is described. A is wrong because A mixed cost rises smoothly because of its variable component. It does not hold flat and then leap in chunks. C is wrong because A purely variable cost rises continuously with each unit of activity. It does not stay flat between jumps. D is wrong because A purely fixed cost stays flat across the whole relevant range without stepping up. The described cost jumps at thresholds, so it is not simply fixed. A stepped cost stays flat over a range of activity, then jumps by a large chunk when activity crosses a threshold, then holds flat again until the next threshold. Plotted against activity, it forms a staircase, flat treads broken by sudden rises. This pattern exists because some resources can only be added in whole units. As long as activity stays within the capacity already purchased, cost stays flat. Once activity outgrows that capacity, the company buys another whole lump, and cost jumps by the full price of it. The mechanism is threshold-triggered jumps. Within a step, added activity changes nothing since existing capacity absorbs it. At the threshold, capacity is exhausted, and the next unit of activity forces a whole new block of cost, flat again across the wider step that follows. The trap is mistaking a stepped cost for something else. Variable cost rises with each unit. Fixed cost never moves within the relevant range, and mixed cost climbs smoothly from a base. Only a stepped cost holds flat, and then leaps at thresholds. That flat then jump staircase is its own pattern. Signal phrases include flat, then jumps in a chunk, steps up at a threshold, and cannot add a fraction. And remember, a fixed cost is only fixed within its relevant range. Push activity far enough, and even it will eventually step up. Question me. One supervisor can oversee up to 10 workers, and the 11th worker requires hiring a second supervisor because a company cannot hire half a supervisor. As the workforce grows past each threshold, how does total supervision cost behave? Your options are: A. It rises smoothly with each additional worker. B. It stays completely flat no matter how many workers are added. C. It falls as workers are added. D. It stays flat, then jumps by a whole salary at each threshold in a stepped pattern. What's your answer? Commit to one before I continue. The correct answer is D. It stays flat, then jumps by a whole salary at each threshold in a stepped pattern. D is correct because supervision cost is flat until a threshold is crossed, then jumps by an entire supervisor's salary, then holds flat again. Because a company cannot hire a fraction of a supervisor, the cost steps up in whole chunks. A is wrong because smooth, continuous increases describe a variable cost. Supervision jumps in whole salaries rather than rising one worker at a time. B is wrong because the cost does not stay flat forever. It jumps once a supervisor's capacity is exceeded. Adding the 11th worker forces a second salary. C is wrong because adding workers raises supervision cost at thresholds rather than lowering it. The cost never falls as the workforce grows. Let's look at why supervision cost is the textbook example of a stepped cost, and why it fools students who expect costs to behave like either pure variable or pure fixed costs. The behavior comes from indivisibility. A supervisor is hired as one whole person at one whole salary, never in fractions matched to headcount. So within the range that supervisor can handle, adding workers changes nothing at all. Picture one supervisor who can oversee up to 10 workers. Cost stays flat at one salary through worker 10. Then the 11th worker breaches capacity and forces a second supervisor, jumping cost to 2 salaries, flat again until a third becomes necessary. Watch for signal phrases. One supervisor per so many workers, cannot hire half a supervisor, jumps by a whole salary, or add a second shift or machine. These phrases signal capacity that comes only in whole units, with cost leaping at each threshold. Supervision cost is neither smoothly variable nor permanently fixed. It's flat within each supervisor's span and jumps by a full salary at the threshold, reminding us that fixed costs are only fixed within a relevant range. Question 45. A delivery operation pays a flat $500 per month to lease a truck plus 0.42 for every mile driven. Which single classification best fits this delivery cost? Your options are A mixed cost combining a fixed lease and a variable per mile charge. B, a purely fixed cost because of the monthly lease. C, a purely variable cost because of the per mile charge. D, a stepped cost because mileage changes from month to month. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A, a mixed cost, combining a fixed lease and a variable per mile charge. G is correct because the cost has a fixed monthly lease and a variable charge that grows with the miles driven, which is the definition of a mixed cost. Both components are present at once. B is wrong because a purely fixed cost would not change with miles, but the per mile charge clearly does. The variable part rules out purely fixed. C is wrong because a purely variable cost would have no flat monthly charge, yet the lease is owed regardless of miles. The fixed lease rules out purely variable. D is wrong because a stepped cost jumps in chunks at thresholds, which is not how this cost behaves. The per mile charge rises smoothly with each mile rather than in steps. Some costs are mixed by design, combining a flat charge you owe no matter what, with a per unit charge that grows as activity grows. Picture a delivery truck. The company pays a fixed monthly lease no matter what, and on top of that, a per mile charge that rises with every mile driven. The lease never moves, but the mileage charge scales with distance. This pattern shows up because operating an asset often combines a commitment with a usage charge. Leasing the truck locks in a payment whether it's idle or busy. While running, it adds fuel and maintenance that scale with distance. So the cost can't be purely fixed or purely variable. Watch for the trap of picking one component and forcing a pure label. Purely fixed fails because miles move part of the cost. Purely variable fails because the lease is owed at 0 miles. And stepped fails because the mileage charge climbs smoothly rather than jumping in chunks. Only the mixed label honors both a steady lease and a smooth per mile climb. Whenever you see a flat charge plus a per unit rate, like a lease plus mileage, that's your signal. It's a mixed cost, not a pure one. Question 46. A manager compares the company's actual costs for the quarter against the budget, investigates the differences, and takes corrective action. Which of the 3 management functions is the manager performing? Your options are A. Planning, B. Directing, C. Controlling, D. Auditing. Which would you go with? Lock it in before the reveal. The correct answer is C. Controlling. C is correct because controlling is comparing actual results to the plan, investigating the differences, and acting on them. Reviewing actual costs against budget and correcting course is the controlling function. A is wrong because planning is setting goals and building budgets for the future. The manager here is checking results after the fact, not setting the plan. B is wrong because directing is running daily operations and making in-the-moment decisions. Comparing actual to budget after the quarter is review, not day-to-day direction. D is wrong because auditing is an external assurance activity, not one of the 3 internal management functions. The manager is controlling, not auditing. Management has 3 intertwined functions: planning, directing, and controlling. Controlling is the backward checking phase, where a manager compares actual results to the plan and acts on the gap. Planning sets goals and builds budgets before anything happens. Directing runs day-to-day operations in the moment. Controlling comes after, comparing actual outcomes to the plan and correcting course. The mechanism is comparison and response. Actual costs are gathered and set beside the budget. Differences called variances are isolated and examined, and managers act to fix what went wrong. Variance analysis and responsibility accounting belong to this phase, along with management by exception, which focuses attention on significant deviations rather than chasing every small difference. Signal language like compare actual to budget, investigate the variances, and take corrective action always points to controlling, not planning or directing. Question 47. A company paid $80,000 for a machine 3 years ago and is now deciding whether to use that machine for a new job. How should the original $80,000 purchase price affect this decision? Your options are: A. It should be the main factor since it was a large amount. B. It should be split across the remaining useful life and counted. C. It should be added to the cost of the new job. D. It should be ignored because it is a sunk cost that no future decision can change. Don't overthink it. Which one feels right? The correct answer is D. It should be ignored because it is a sunk cost that no future decision can change. D is correct because the $80,000 was already spent and cannot be changed by any future choice, which makes it a sunk cost. Sunk costs are never relevant to a decision, so it should be ignored. A is wrong because the size of a past payment does not make it relevant. A sunk cost stays irrelevant no matter how large it was. B is wrong because spreading a sunk cost over future periods does not make it relevant to this decision. The cash is already gone regardless of how it is recorded. C is wrong because adding a past, unchangeable cost to the new job would distort the decision. Only costs that differ between the alternatives belong in the analysis. A sunk cost is money already spent in the past that no future decision can undo. Because it stays exactly the same no matter which option you choose, it should never sway a decision. The test is simple. Does the cost differ between alternatives? A sunk cost is identical under every option, so it cancels out of the comparison and has no power to tip the decision. Picture a company that paid $80,000 for a machine 3 years ago and now decides whether to use it for a new job. That $80,000 is gone either way, so it cannot affect the choice. Only the future costs and benefits of the new job matter. Watch for phrases like already paid, incurred in the past, or cannot be changed. These flag a sunk cost to ignore. Contrast that with relevant costs, which are differential or avoidable, and even unavoidable future costs, which are irrelevant for a different reason. They're identical across options, not because they're already spent. Whatever its size or how it's recorded, a cost already paid stays sunk, so set it aside and let only the future decide. Question 48. Filling a special order would use production capacity the company would otherwise have used for its regular sales, forcing it to give up the contribution margin on those regular sales. What is that foregone contribution margin called? Your options are A sunk cost, B, an opportunity cost, C, a direct material cost, D, an unavoidable cost. Got a guess? Lock it in. The correct answer is B, an opportunity cost. B is correct because an opportunity cost is the benefit given up when one alternative is chosen over another. The loss contribution margin on regular sales is the benefit foregone by taking the special order, so it is an opportunity cost. A is wrong because a sunk cost is a past, unchangeable outlay. The foregone margin is a future benefit given up, not money already spent. C is wrong because a direct material cost is a traceable input to the product, not a benefit foregone. The loss margin is not a material that was purchased. D is wrong because an unavoidable cost stays the same under every alternative and is irrelevant. The foregone margin arises specifically because of the choice. so it is relevant. An opportunity cost is the benefit you give up when you choose one alternative over another. It never appears in the accounting records, yet it's a real, relevant cost of any decision. This concept exists because resources are limited. Committing capacity, time, or capital to one use means sacrificing the benefit that resource could have produced elsewhere, even though no invoice ever records that sacrifice. Consider a special order that consumes capacity otherwise used for regular sales. The contribution margin lost on those displaced regular sales is the opportunity cost of accepting the order, and it must be subtracted from the order's apparent benefit. Don't confuse opportunity cost with a sunk cost, which is a past outlay, or an unavoidable cost, which doesn't differ between alternatives. Opportunity cost is relevant precisely because it arises from the choice, even though it's the value of the road not taken. No cash changes hands, but the foregone margin is genuinely lost. Recognizing a real cost that leaves no trace in the ledger and weighing it in the decision is the key insight. Question 49. A manager is told that the direct materials, direct labor, and variable overhead for a product line would all disappear entirely if the company stopped making that line. What kind of cost goes away like this when a particular alternative is chosen? Your options are A. An avoidable cost which is relevant to the decision. B. A sunk cost which is irrelevant. C. An unavoidable cost which does not change. D. An opportunity cost which is a benefit foregone. Which one is it? Pause the video if you need more time. The correct answer is A. An avoidable cost which is relevant to the decision. A is correct because an avoidable cost is one that can be eliminated by choosing a particular alternative, and avoidable costs are relevant. Direct materials, direct labor, and variable overhead are always avoidable, so dropping the line removes them. B is wrong because A sunk cost is already spent and cannot be eliminated by future choice. These costs disappear going forward, so they are avoidable, not sunk. C is wrong because an unavoidable cost remains the same regardless of the choice. These costs vanish when the line is dropped, so they are avoidable, not unavoidable. D is wrong because an opportunity cost is a benefit given up, not an outlay that goes away. These are actual costs that disappear, which makes them avoidable costs. An avoidable cost is a cost that disappears entirely if you choose one alternative over another. Simply put, avoidable costs are the costs that go away, and that makes them relevant to the decision. Direct materials, direct labor, and variable manufacturing overhead are always avoidable because they vanish the moment the activity causing them stops. The mechanism is simple. Ask whether a cost would still be incurred after the decision. If dropping a line ends its material purchases, wages, and overhead, those costs are avoidable, while committed rent that continues regardless is not. Don't confuse avoidable costs with the traps. A sunk cost is already spent and can't be eliminated. An unavoidable cost persists no matter the choice. And an opportunity cost is a foregone benefit rather than a disappearing outlay. Only the avoidable cost genuinely goes away, which is what makes it relevant. Watch for signal language like goes away, eliminated, or saved by stopping. That's your cue that avoidable, relevant costs are in play. Question 50. A company is deciding whether to use its existing machine to take on a new job. The factory rent will be paid whether or not the job is accepted, while the extra electricity and raw materials would be incurred only if the job is taken. Which costs are relevant to this decision? Your options are A. Only the factory rent because it is the largest fixed cost. B. All three costs because they all involve the factory. C. The extra electricity and raw materials because they differ between accepting and rejecting the job. D. None of the costs because the machine is already owned. Take a second. Which answer would you pick? The correct answer is C. The extra electricity and raw materials because they differ between accepting and rejecting the job. C is correct because A cost is relevant only if it differs between the alternatives. The extra electricity and raw materials are incurred only if the job is accepted, so they differ and are relevant. A is wrong because the factory rent is paid either way, so it does not differ between the alternatives and is irrelevant. Its size does not make it relevant. B is wrong because costs that stay the same under both choices, like the rent here, are irrelevant even though they involve the factory. Only the differing costs matter. D is wrong because owning the machine does not make every cost irrelevant. The extra electricity and materials still differ between the alternatives and must be weighed. A relevant cost is simply a cost that differs between the alternatives you're comparing. If a cost stays the same no matter what you choose, it cancels out and shouldn't affect the decision at all. Differential, opportunity, and avoidable costs are all relevant because each one changes depending on which alternative you pick. Sunk costs and unavoidable future costs are irrelevant because they stay locked in place no matter what you decide. Picture a factory deciding whether to take on a new job using a machine it already owns. The rent is owed whether or not the job is accepted, so it never changes. But the extra electricity and extra raw materials only show up if the job is taken, so they differ between the two choices, and that difference is what makes them relevant. The whole trick is a single question asked cost by cost. Would this cost change if a different alternative were chosen? A big, real expense can still be irrelevant if it's identical across every option, because size and location never determine relevance. Only difference does. So variable costs tied to a specific choice are usually relevant, while committed or sunk costs usually aren't, because relevance is always about difference, never about size. That wraps up our question and answer review for Domain 1, Foundations of Cost and Managerial Accounting. If you want more practice with everything we just covered, head over to our website. You'll find the link right in the description below. There, you'll discover hundreds of free practice questions along with complete study guide, all designed to help you review comfortably and effectively at your own pace. Subscribe so you don't miss the next part, and good luck on your exam.